Welcome to NASDAQ Trade Talks. I'm your host, Jill Malandrino, global markets reporter at NASDAQ. Joining me at the market site in Times Square, we have Jeff Schultz. He is an investment strategist with ClearBridge Investments. We are going to take a look at ClearBridge's recession risk dashboard and what it's pointing towards. Jeff, it's great to have you back with me. As always, the recession risk dashboard, consumer still remains the pillar of strength, but what's the bigger picture?
Yeah, so the dashboard turned yellow officially in July, and it's remained yellow here with the output that we have here in October. We have 6 overall green, 3 yellow, 3 red, but most importantly, the consumer is all 4 of those variables are green right now, which signifies that they are the bedrock of the economy, and it makes sense because they're 70% of our economic activity.
What does it mean when you say that it moved to yellow? Does that mean a recession is imminent, or there's just more risk factors that are out there?
Doesn't mean a recession is here yet. It just means the recession risks are rising right now. We think that the odds of a recession over the next 12 months are 50-50 or a coin flip. Importantly, when it turns yellow, it doesn't necessarily mean that it goes to a red signal. Red's the much more powerful signal because we've only had 8 red signals in the dashboard's history. 7 out of 8 of those ended up being a recession. We've had 3 yellows that went back to a green with a reaccelerating economic backdrop. Those were 95, 98, and then 2016. So right now, we're not sure which direction the economy is going to go.
All right, let's take a look at our first chart here. This is U.S. recession risk indicators. This is what you're looking at that goes into the recession risk dashboard.
Correct. Yep. So you can see that the output, we've had a couple of variables change from the second quarter to the third quarter. Job shipment went back to green. ISM, manufacturing PMI new orders went from yellow to red. And then profit margins went from green to yellow. And that's a really important consideration because we look at NIPA profit margins, which is a much more holistic view of what's going on in the economy. Looks at micro, small, mid, large, and mega cap companies. And you saw a $200 billion revision down in NIPA profit margins in July, which means your micro and small cap companies, which are the bread and butter of the U.S. economy, are really starting to feel some margin pressure due to higher compensation costs.
All right, let's move along to our next one. Global central banks are in easing mode. There's been no shortage of conversation around that in central bank activity.
Yes, we've seen quite a turnaround over the last 8 months, and this goes into the slowdown camp rather than a recession camp. Coming into the 2019, you had 42% of banks, central banks, that were hiking, 0% which were cutting. 8 months later, you have 0% which are hiking, and all the way up to 52% of central banks are easing. So part of the slowdown narrative rather than an outright recession is that global central banks have gotten the message and they're providing the liquidity that's needed for this slowdown to reaccelerate.
All right, shadow Fed funds rate, how does this tie into all the different risk parameters that you're looking at here?
So one thing that we think will happen over the next 6 months is that we're going to have a growth slowdown. Right? There's going to be a growth scare or recession scare, and a lot of it is predicated on the fact that the Fed has tightened a lot more than what meets the eye with rate hikes. And even though you've had 225 basis points worth of rate hikes, they've also ended their quantitative easing program. They've done $600 billion worth of quantitative tightening or selling bonds off their balance sheets. They've also done forward guidance, and when you take those other subjective things into consideration, we put together the shadow Fed funds rate, which suggests that tightening has occurred of over 550 basis points. And because Fed tightening has a lagged effect on the U.S. economy of 12 to 18 months, that means today we're really just feeling the third rate hike of what we saw back in 2018. So to put it differently, the economic cake is baked for the next couple of quarters.
Wow. So then if we go to our next one, low U.S. rates reflect a softer economic backdrop.
Yeah, so I think there's a misconception out there about what's happening with the 10-year Treasury. A lot of people think that it's crossover buyers that are coming from Japan and over in Europe because of negative interest rates and buying the 10-year Treasury. But if you take out hedging costs into consideration, it's actually not a positive deal for them. They would actually lose money on that trade. You only see crossover buyers really in credit products, things like corporate bonds, agencies, and mortgage-backed securities. What we think that what's happening with the 10-year Treasury is it's really drawing down because the U.S. economy is slowing. And you can see from the chart here that the 10-year Treasury has mirrored manufacturing and PMI, which is a good measure of what's going on in the economy. So lower rates really is a reflection of slowing U.S. growth and maybe a recession over the next 12 months.
All right, and that's a question that we're asking on the next slide. Are we running out of ammunition?
Well, if you look at the last 7 rate cut cycles that we've seen, on average, it's taken the Fed 7.4% worth of rate cuts to get us out of that recession. This time around, we have about 2.5%, which suggests if we go into a recession, they're going to obviously cut that down to 0, but we're going to need a little bit more ammunition in order to get us through that slow patch.
All right. Moving on to our last slide. Now, the obvious question is, do we have more room for QE?
Well, I think this is obviously the route that they're going to go. I think we're going to see QE on steroids if and when we have the next recession, because we need to make up for the lack of room that we have on the short end of the curve. But our balance sheet looks a lot better than what you see over in Japan. Our balance sheet is 1/5 the size of the Japanese balance sheet. It's over less than half than what you see over in Europe. So I think QE, even though we haven't seen it in about 5 years, if a recession's on the horizon, it's going to be back on the table.
All right, thank you so much, as always, for joining us at MarketSite. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.